do you have the time, energy, risk tolerance, perseverance to even attempt to do this? Because unlike a stock or a real estate, you can get into a stock in 5 minutes, a real estate, probably 30 to 90 days. It will take you a year to buy a small business.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. And before we begin, I want to remind you of a few things. There's a website that you should check out called wealthformula.com, really the home of this podcast. It's also where you can find some resources related to personal finance, as well as a place to sign up for various lists, including the Accredited Investor Club list. If you are interested in potentially looking at alternative assets and that kind of thing, it is a good place to go to see deal flow, but you got to sign up and you got to get onboarded, fill out some forms saying you're an accredited investor, and ultimately go through that whole process. Not a significant one, but it is some of a formality so that you can actually see some of these things that are out there that are invisible to the general public. Again, that is Investor Club at wealthformula.com. Now, let's talk about what's going on. It's crazy out there, right? As I am recording this, actually, and I always typically record this, the week before, but yeah, this massive across the board tariff placement by the Trump administration, which killed the market, but it also, also started to do some weird things with the bond market, which is ultimately what I think probably spooked the Trump administration into doing what they did thereafter, which was to essentially put a 90-day hold on it. I will say that, gosh, I've talked to you on this show about what I felt that Scott Bessent's message was about tariffs and that there would be temporary pain. They felt that it was not necessarily inflationary, but would create a temporary reset of pricing. But that part of that pain would also result in a benefit to the bond market, basically pushing down the 10-year treasury and helping with the cost of lending. So none of that seemed to work. And the thing that I worry about the most, frankly, on this is the fact that there was a pause put on. And one of the major purposes to, even stated from Scott Bessent was leverage over other countries. And frankly, one of the things that I'm most worried about now is that, how do these countries take us seriously when we keep going back and forth herky jerky like this, or just, and how are the markets supposed to react? If you're a small business, what are you supposed to do with this? Now, granted, China is still getting the shaft, right? They're like at 125% tariff. But the rest of the world, it's unclear what happens at that 90 days. And the problem with the economy and with businesses, with businesses in general, having been a business owner myself, and I am a business owner. I don't necessarily deal specifically in the world of Chinese imports or anything like that. But if your company has a significant, aspect to it where you're dealing with various countries, including China, what do you do? What do you do if you are, you know, dealing with some of the other countries that don't have, like India, for example, or other countries where there's not necessarily the same kind of issues that go along with China? You can't very well just say, well, we're gonna move our strategy from China to another country at this point. I guess the only thing that's potentially safe is to come back to the US, which is, presumably what the Trump administration wants. But, if they don't stick to some sort of real direction, I think that creates the biggest problem of all for businesses, which is simply not having stability and not being able to know what to count on. So what they're going to do is to do nothing right now. And that is going to be bad for the economy as well. So anyway, a little kind of bummed, frankly. I mean, I didn't want to see huge tariffs, but at the same time, I just think the continuity of policy is important for business. And so we'll see how that goes. In the meantime, though, speaking of businesses, some of these businesses out there might have some trouble. Some might come out and start to be sold at prices that are attractive. And so I've been thinking lately, well, gosh, maybe I should get involved with the purchase of a business. You know, the market seems like it's crashing around us, of course, but we're probably headed into a recession. But then again, I started my first business back in 2009, and maybe it doesn't get worse than that. I don't know. Maybe. Well, maybe it can. And if that's the case, then that might be another reason to actually consider, rather than starting a business, to buy a business instead of having the volatility of starting one, which I've done in the past, particularly because of SBA loan options available right now. So let me give you an idea on what these SBA loans are like, because I think it's pretty compelling. So so there's a loan called the SBA 7A loan, which is you can use to acquire businesses. It's a loan up to about 5 million bucks. So you can potentially buy something, up to $5 million, and that sounds very expensive, and it is. However, here's the thing: the SBA loan is very useful. Let's just use the example of a $1 million business, and let me just explain how this loan would work. So if you were buying something for $1 million, business for $1 million, your down payment on that, for these things is only 10%. So you'd have to put down $100,000. And of course, you're financing the remaining 900,000. But here's the thing: the loan term on these things is like 25 years. Yeah, that's 25 years. So even though you're paying a monthly payment of like 10.25% annually, the payment ends up coming out to about $8,200 on that per month, right? So $8,200 per month to borrow $900,000. Now, that monthly payment isn't exactly cheap, I know, but consider this: a business that you buy for $1 million typically is going to be one that is sold at about 3 times its annual earnings, 3 times cash flow, basically. And so, for those of you who are more comfortable in the real estate world and real estate terminology, that translates to what we would call a cap rate of about 33, 34%, right? We're used to cap rates around 6. We get excited at 7, things like that, usually. And we've been, even sub 5, you know, but 33 to 34%. And remember, anytime your cap rate exceeds your interest rate on your loan, leverage is going to work in your favor. So let's break that down again with real numbers. In this situation, that would suggest, okay, annual earnings were about 333,000 and 333, right? Because we're talking about 3 times earnings. Okay. And annual debt service on that $8,200 is $98,400. So your annual cash flow comes out to around 234,933 after you pay off that debt. And since you only invested $100,000 to get this cash flow, you're looking at a cash on cash return there, about 235%. So sounds like a pretty good deal, right? Pretty impressive. Well, of course it is. But the problem with small businesses, and one of the things we're going to talk about today, is the devil is in the details. These are highly volatile businesses, and their success often hinges on, key factors that don't necessarily transfer smoothly to a new owner, right? The thing about it is these businesses, the reason smaller businesses like this, the reason they trade at these kinds of multiples or cap rates, as we like to think about them, is because there is greater risk with them. Businesses always have greater risk. Startup businesses, and some people have your experience on even investing in it. Startup businesses are inherently incredibly risky, right? Anyway, a business of about $5 million should be potentially stable. So that's why I wanted to, point out that SBA loan does go up to about to about 5 million, which would mean you'd need to put down about, half million bucks. But what if you did that with, a business partner? Now you're $250,000 each, and you've got a reasonable sized business that is already throwing off over $1 million a year in cash flow. So it's really potentially a really compelling thing. But again, if it were that easy, everybody be doing it. And it's not that easy, but it might be worth it. That's certainly what my guest this week on Wealth Formula Podcast thinks. He is an expert on small business due diligence and is really thinks that people are missing out by not looking at the possibility of buying them. So when we come back, we'll have this interview, and I think you'll find it very interesting. Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash flowing investments. Here's the key: even though you borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Elliot Holland. He's a Harvard Business School grad and founder of Guardian Due Diligence. He's known as the small business due diligence guy, helping entrepreneurs avoid bad deals before they buy. With over a decade of experience and more than $250 million in deal volume under his belt, Elliot knows how to spot red flags before they become regrets. And welcome to the program.
Good to be here. Thanks for having me, bud.
Yeah. So, Elliot, tell us a little bit about your background in business acquisition that ultimately kind of got you into this, this niche of due diligence.
Sure. So when I was at Harvard Business School from 2009 to 2011, it predated sort of the small business acquisition rampage that we see currently. And at that point, all of the people said that deals under $2 million of cash flow were abysmal for acquisition, not worth your time, and only do big deals, which of course benefits those ultra rich people at the expense of poor people who are trying to get their feet underneath them. And so my path into sort of investing came through smaller investment firms that focused on smaller deals and increasingly moving towards owning equity in those things. So when I left business school, I worked at a private equity firm that was really a family office that was doing private equity deals out of Boston called the Watermill Group. I then sort of saw the lifestyles and the wealth created for those investors and convinced a mentor of mine who had been doing independent deals to work with me as an independent deal person. They call them independent sponsors. So we started Ellsworth Partners. We did 3 acquisitions into that. And then I spun out as a self-funded searcher a decade ago, 2015.
Self-funded what?
Searcher.
Searcher?
So people who look for small businesses to buy are called searchers. You're searching for a business to acquire.
Okay.
And so I spun out as a self-funded searcher in 2015. The market was still really early. And 2 years later, I started Guardian Diligence, my due diligence firm, because the skills around business acquisition are not easy to learn. You can really only learn them training under people who have had decades, and they only hire you if you're already informed. And so when I started Guardian, it was basically to counteract this conversation of easy $1 million deals with no money down, to help people not get had by all the lies and snakes that are in this industry.
Cool. Let's talk a little bit about, it's interesting you brought up the large business concept. Actually, my brother is a guy who used to do large acquisitions at M&A, and he ran a sovereign wealth fund. When I talked to him about business acquisition, basically his take was anything less than a $5 million EBITDA. It was not something he would ever even consider touching, just because of all the potential landmines. Talk a little bit about that. I mean, I kind of understand why, but why would people say that? And in your opinion, what is the reality?
He's not wrong for him. So let me describe 3 types of investors. An ultra rich one managing a bunch of other people's money. A medium rich one that's still well capitalized but has some capital constraints, probably not dedicated capital. And then what I'm going to call an everyday dude or gal hustling, trying to make a whole lot more money than they started with at the beginning.
Sure. Yep.
For the third bucket, that whole $5 million of EBITDA or above is laughable.
Right. You're not going to pay, 50 million bucks to,
You don't have it.
yeah.
You could kill 10 people and still not get it.
Right, right, right.
So the concept for the super rich, the first bucket, is a convenient one, even if it's accurate. The poor person would love $5 million of EBITDA because it's less volatility.
Yeah, of
They'll
course.
never find it. It's like, I would like to date Beyonce.
Right.
It's not going to work.
But
So
explain why. Explain what the reservation of people to buy, the smaller businesses are. Because what is it about and again, I can, I know sort of the answer from talking to my brother, but what is it that people that you've learned that you've experienced that people are most concerned about at these various thresholds, whether that's be, $5 million of cash flow or $2 million of cash flow, $1 million of cash flow, that kind of thing.
the smaller the business, the more volatility it is,
Right.
which should be obvious to people because at a startup, it's me and a computer screen and an idea.
Yep.
Super volatile. At Amazon, me going in and doing a 20-hour day doesn't move the stock value of that company at all. So on the extremes, you get it.
Yeah.
So now the closer you are to zero, the more volatile it is. You lose one customer, and that's 30% of your revenue, maybe 50% of your profit. At $5 million of EBITDA, you probably have 30 customers. You don't have the same risk. You probably have a lot more of a management team. At $5 million of EBITDA, you have a couple of folks loosely working together at $1 million of EBITDA. And so everything is riskier as you get smaller. The beauty is the debt markets are favoring the smaller deals in a way that you can't get the same debt on the $5 million EBITDA businesses.
Oh, is that right? So when you say small, how small are you talking about?
I'm talking under $1 million of EBITDA or cash flow.
Okay. And one other thing I'd like to just, point out because I think, and you know this, but I want to make sure the audience understands the other thing I understand about risks in those kinds of businesses a lot of times has to do with, okay, if you're a small business and, I've started a few different small businesses and I know this from personal experience, but there's usually, for example, key personnel, right? Like without this person, you don't have a business anymore.
Sure.
That's a big risk. And when you're buying something, you don't know who those people are, and necessarily. There's also for businesses that are B2B, they may just not have. Like I know one guy who's doing pretty well, but I think 90% of his business comes through Granger Company, right? Like he's basically at their mercy constantly. So you have these kinds of variables as well that you have to account for. Is that fair?
I would disagree a bit.
You
Here's
would.
why.
Okay.
I think if you sit in a business for a day, you'll know who the key people are. I think people are too lazy to do it. I think I would buy a business where 90% of my customer load was Granger if I had a contract.
Yeah. Yeah.
That's way better than 200 customers with no contracts. So I think risk is relative. And I think too often we speak about it and others speak about it in absolutes. And that's what kind of frustrated me when I was at Harvard Business School is these absolute conversations didn't take into effect the real constraints for an everyday investor trying to make money.
Yeah. Interesting. Okay. So let's talk about some of I mean, green flags first. We'll specifically focus on businesses of cash flow of less than $1 million. Okay. Say I come to you and I say, hey, Elliot, in your searcher days, I make a good income and I'm making, let's say I'm making 700,000 to $1 million a year. I'm really like trying to find out, if I want to like make sure that I'm, not just buying real estate, not just putting money in stocks. I actually want to, go out there and maybe venture into the business world and try to make some money that way or invest that way. What kinds of businesses do you think would be potentially safer for me to acquire? Things I should be looking for that give you some good feeling that this might be something to pursue, the qualities of that business.
Sure. So I think property management companies are pretty good because they're contractual, they repeat revenue, that kind of thing. I think any sort of business that has contracts, so even like landscaping companies have contracts sometimes. I think those are good. But I would actually flip it, Buck, and say, let's talk about the process of buying a business under $1 million of cash flow, because I think what's more important is do you have the time, energy, risk tolerance, perseverance to even attempt to do this, because unlike a stock or a real estate, you can get into a stock in 5 minutes. A real estate, probably 30 to 90 days. It will take you a year to buy a small business.
Yeah.
And so if you don't have a year of dedicated time that you're not spending 60 hours on somebody else's clock, if you don't have a risk tolerance to deal with just unknown risks, like in a real estate, you're like, oh, maybe it goes up 5%, it goes down 5%. In a stock, you can get in and out of it at any given time. So you have risk sort of mitigation there. This is a bet that you have to make on a single day for 3 to 5 years. And so you need to have a risk tolerance and a timeline that makes sense. So the first
Yeah.
thing I would ask you is, do you have a year? And do you have a risk tolerance to take on something more risky than even a private real estate deal?
Sure. Sure. That makes sense. And when they'll go to a searcher, and again, I'm just trying to give this context for people to take them through an entire process. They say,
Sure.
okay, well, how do I even source a business? And you mentioned searchers, but then there are these like online platforms like Biz Buy Sell, all that. I mean, are these things like, for example, in real estate? I mean, I know just from being a real estate guy that you don't go to LoopNet typically to buy real estate because it's where real estate goes to die often. But like, where are these things typically advertised on platforms, or are you better off with a searcher? Or are they kind of looking at the same thing? How does that work?
So first off, I provide financial diligence services for people who are buying businesses, and I coach people on how to buy businesses for the first time. So those are the two things that I do. I would say that LoopNet probably is the same as Biz Buy Sell, because I bet you everybody's first deal that they look at is on there. Because until you know anybody, you can't call any favors in. Nobody's going to show you any off market deals. So I think I talk about Biz Buy Sell as the McDonald's. You're not going to go take your family on an anniversary dinner to McDonald's, but probably one of your first meals in high school is probably McDonald's. And so what you have to do is sort of cultivate a network of people who are in the business buying ecosystem, which is why it takes longer and you can't do it as quickly. So my thing is, you might not like Biz Buy Sell, but if you never have the gumption to get past it, then you're kind of dead in the water, because this is what I tell you, most of the other databases are just repackaging Biz Buy Sell stuff and selling it to you at a upcharge price.
But a searcher would have more sort of insights, or are they
Well,
typically into
to
the same?
me, like, this isn't a private equity play where there's LPs and GPs.
Right.
When you're buying a business under $1 million of cash flow, 90% of the people who are in deals like that, they are the LP and the GP. They
Right.
are the
Sure.
investor and the searcher.
Sure.
They're the whole thing. And so there are some small pockets of people who are investing in others who are buying companies of that size, but it's not the same as the larger ecosystem where you can be kind of a passive player and an active one.
No, I get that, but I guess I'm just trying to understand, like, should people, when they're just going to those sites, should they be hiring a professional to help them analyze these businesses? What kind of professional would that be? I think you mentioned you called it a searcher. Is that something applicable for this size of business, or, are you pretty much kind of on your own in this?
Can you hire somebody to do a search for a commercial real estate building for you?
I mean, you got a real estate agent, right?
Well, that's
Um,
the business broker.
yeah, I mean, you have
But
a
do
real
they find stuff that's highly valuable because when they buy it themselves?
No, they absolutely would find it, because a lot of times, if you're buying, rental property, that would be a couple $1,000,000. Real estate agent may not have a couple $1,000,000, and their business is actually to, make money off of commissions. So they've got a business model themselves.
So it's a
So
very different ecosystem around business acquisition. And I think that's probably why we're not seeing eye to eye currently, is because the whole ecosystem's different. Um, when you desire to go buy a business, there are no buy side brokers of any substance. There are only sell side brokers representing the sellers of businesses. And those are the ones that post information on places like Biz Buy Sell. So that's a little bit different than real estate as well. There are people who will take your money to go say they're doing a search for you. I say it's not worth it, because until you do it yourself and understand what works, what doesn't, you're not in an ecosystem that favors trust and the reliability of your counterparties. You need to sort of feel that out for yourself. So the first probably 3 months of anyone's desire to buy sort of $1 million cash flow business, which typically is going to be about a $3 to $5 million purchase price, is going to be them themselves going to McDonald's, Biz by Sell, looking at deals, inquiring about them, doing the work themselves, putting together a system. And the reason I have a masterclass around it is because it's not obvious on how to do it. You can't just go search for a deal for you.com and have somebody do it. So even rich people who are making the 700K you mentioned like 10 minutes ago don't have a place to outsource this activity to.
Yeah. So that's where you come in, right? Is that, so tell us a little bit about kind of what you do, at a 1,000-foot level.
Sure. So I help people through two pieces of the process. So if you were the $700,000 earner and you said, hey, I want to get out of sort of public stock markets and real estate and I want to go buy a business, you would be making too much money to go spend a year putzing around making mistakes
Right.
to do it completely by yourself.
Yep.
You would probably be a great candidate to get someone like myself to help you understand the pieces of the process and to do it with me. I don't do it for you, but we can do it together. And so you would pay the fee. There'd be some sort of curriculum based pieces of it, but there's some weekly sort of one-on-one stuff that goes along with it as well. And so you would condense probably what would take you 6 to 9 months to learn by yourself into 30 to 60 days, because people of means don't have the 6 to 9 months to learn and honestly don't want to take the pain for that long most times. Does that make sense?
Oh, yeah, absolutely.
Then the second piece of it, let's say you find a bright, shiny deal. Well, unless you are a forensic accountant, the other thing that's different about business acquisition compared to real estate, in real estate, there's an appraisal.
Mm-hmm.
So qualified appraisal people that go get appraisals, and if they say it's $1 million or $10 million, maybe it's off by 5 or 10%, but directionally correct, and lenders will lend on it. And everyone sort of knows that's the
Yep.
best valuation. What's funny in small business acquisition is that the valuation people, the true valuation folks, are sort of the bottom of the totem pole for valuation. So because valuation is a multiple of cash flow, and typically it's about 3 to 4 times cash flow, what that means is you have to really dial in on cash flow. Small business financials are messy. And so my second advisory role is a financial due diligence provider. So say you come in as a $700,000 earner, go through the masterclass. Now you know the process and how to be efficient in executing. You find a great deal. Now you actually have to do financial due diligence. So I would help you with that to make sure that, okay, they said the profit was $1 million of cash flow. It's really $640,000. So the offer you made on $1 million isn't relevant anymore. And then I'd help you get to a point of renegotiating that deal to make sense for the $640,000. That's the actual true profit. So you can still do a deal if the seller will accept a fair price for their asset. And so after the two of my services, you'd be the owner of a small business without having to worry about 6 to 9 months of wasting your time or buying a lemon, because the appraisal gives you a floor on valuation. So if somebody said the building's worth $4 million, you pay $4 million, you'd be comfortable.
Yeah.
There's no real way to do that in small business acquisition outside of the financial diligence product, which is a audit-like product called a quality of earnings. That is the other product that I provide for people who are looking to buy businesses.
One of the things that it's important in this space, obviously, if you're talking about somebody even who's making, 700 grand a year or whatever, to buy something for purchase price of 3 to 5 million is still something that they could probably use a loan for. So smaller businesses have, correct me if I'm wrong, but they have an advantage where you could potentially use an SBA loan here. Is that
Exactly.
right? And so talk a little bit about how that works. Again, these, just so for people don't understand.
Sure. So I mentioned 15 minutes ago that the debt you can get on a small business is way better than our private equity friends can get on a larger business. And that probably perked up some of your ears. How? The smart people can't get the same debt. Here's why. The SBA program is set up to help everyday Americans buy businesses, primarily from baby boomers, but any sort of business sellers, that enables more people to get in the marketplace so there can be a more active market for this asset class that 10 years ago there was no market for because nobody could afford it. There was no debt. So with an SBA loan, you could put down as little as 5%. So for $1 million business acquisition, you could put up 50 grand and own 100% of it. And so typically in a private equity transaction, the equity investor has to put down 20 or more percent. So you're putting down sort of 1/4 as a percentage of full purchase price that a private equity investor could put down. And the difference is under the SBA, you have to put a personal guarantee behind that debt, whereas the private equity professional wouldn't. And so you pay off the debt on your SBA deal and you turn $50,000 into $1 million, 20 times return.
Yeah. And what's actually interesting about that to me, just, when I hear the numbers and multiples that you're talking about, you're buying these businesses, if you're buying it at 3 to 4 times earning, in real estate terms, that would be a cap rate of either, 33 or 25,
33. Yeah,
33 or 25%. And understand in real estate, typically
that's
we're
unheard of.
buying at 5% cap rates. So those numbers can be really, really attractive. I mean, a $5 million business is not that small and unstable, right? Necessarily. So, like, I guess it's just shows that it's appealing because you could be getting into a $5 million business for, I think what you're effectively saying is like about 250 grand. And then because of the cap rate, the cash flow is going to be able to service this debt and still come out with a profit, presuming you haven't bought a lemon.
Yeah, that's
Yeah.
it.
Really fascinating. What are some
And
of your
so
favorite?
let's push it
Yeah.
a bit further. So
Yeah.
to 20x your money in real estate would probably take longer than your lifetime.
Well, it depends, right? Because now remember, the difference is like in real estate, if your plan is to just hold for 5 years and you've doubled net operating income, or you've increased it by 50%, which is t- common because we use so much leverage, right? And then even if you sell at the same capitalization rate, think about that multiple. It's crazy. You just earned that multiple. So there is, but it's a different type of,
It's a
it's a
lot
good,
tougher, and then
yeah,
you also have to make the assumption you can find a better place to put your money than just holding it in that asset and continuing to pay down debt. So can you do it on an absolute basis? Sure. Do most investors do it when given the chance? No, because they'd have to find another real estate investment with a better return than just paying off the debt in their own asset. The risk reward profile is totally different between real estate and business acquisition. And so where a lot of real estate investors get into business acquisition is to increase their return. But some people like the return math is kind of a more advanced investor thing. A more nascent investor just thinks how quickly to double my money, triple my money, can I 20x my money? And in this endeavor, people are doing that if they're willing to take on the more risk. That's what makes it so exciting. That's why you're hearing such a buzz about the whole industry.
yeah, interesting. Elliot, what are some of your favorite types of small businesses?
Sure. I think my favorite ones are ones where you can differentiate on service in some sort of recognizable way. So there are a lot of the term is boring businesses,
Yeah.
and I
I
use
talk
that
about
loosely.
boring all the time, so that's very good.
Perfect,
It's perfect.
perfect. So, but a lot of boring businesses have not invested in technology, service, marketing, much of all, or much of any. And so I'll give you an example. One of my buddies in Cleveland, he has a plumbing business. Great business when you need it. Not the cleanest business as the owner, but you make a lot of money pumping that poop, right? Well, he just invested in technology, both internal to his operations. He invested in marketing and advertising technology, so to do sales more efficiently. He has invested in sort of like standardizing his truck fleet. So when he's riding around Cleveland, every truck looks the same. It looks great. It looks clean. And he's, gosh, 5x, maybe 10x revenue in the past 3 or 4 years in plumbing,
Yeah.
which means that the technology of the actual service you're doing hasn't changed in decades.
Right.
The advertising platforms you can use hasn't changed. He's just doing more in those platforms than anybody else and kicking everybody's butt.
Right.
I think landscaping looks like that, roofing, HVAC. A lot of these sort of blue collar industries haven't been touched by a more kind of mainstream technology enabled owner in a long time. And if you can come in and then both make an acquisition at a fair price and then use your brain power or knowledge, maybe you work in a Google Ads platform, maybe you do marketing somewhere. If you can actually go in there and really make those systems more efficient, you can make huge earnings quickly. Or if you can afford to hire people who have already demonstrated excellence in those things, now that you're the owner and can afford to pay those people, you can get the same return.
Right. Fascinating stuff. Well, again, your business is called Remind me.
Guardian Due Diligence.
Guardian Due Diligence. And how can people reach you?
GuardianDueDiligence.com, or
Okay.
go on to YouTube, Guardian Due Diligence. That's my number one social. We've got over 300 videos, at least 3 a month. And so you can get a lot of information there as well.
Okay. It's been fantastic. Thank you so much for all this information.
Thanks, Bob.
We'll be right back. You make a lot of money but are still worried about retirement. Maybe you didn't start earning until your 30s and now you're trying to catch up. And meanwhile, you've got a mortgage and private school to pay for and you feel like you're getting farther and farther behind. Good news. If you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator. It can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com. Again, that's wealthformulabanking.com. Welcome back to the show, everyone. Hope you enjoyed it. The one thing that I didn't mention in there is that we didn't talk about is franchises. We've had plenty of shows on franchises before, and franchises have sort of an interesting thing. You can use an SBA loan for those too, by the way. So if you're wondering, how do I get a franchise and with some of these costs, you can get an SBA loan right there too. The benefit of a franchise is obviously it's sort of a proven business model. But I mean, again, to a certain degree, if you're buying a $5 million business that is throwing off over $1 million a year for multiple years in a row, that's a proven business model too. There are, startup considerations for franchises often, although you can buy them. The one thing that's a little bit of a turnoff for me, frankly, is that usually there's like an associated franchise fee that can take a pretty big bite into your bottom line because they're usually based on gross revenues. And they might actually be better for some people who are slightly less entrepreneurial and who are better at being students, because I think a franchise requires you to really follow the book and do exactly as has been done before. And if you're good at that, you have a higher level chance of success. So anyway, consider that as well. Anyway, that is it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.